Lynch is widely regarded as one of the best investors of our time. From 1977 to 1990, he managed the Fidelity Magellan Fund, and he delivered an average annualized rate of 29.2%, which was more than double the S&P 500's return during that time. Over the years, he turned 18 million into $14 billion. So let's talk about his framework. First is to invest in companies that you know and understand. Lynch made the complex simple. He only invested in companies whose business model he liked and he likes and used their products. If you can't explain the company to a 6-year-old, you should not invest in it. For example, let's talk about Apple. They make phones and computers, and their business model is fairly simple. People really like their products. Many people are invested into their ecosystem. Once they buy their phone, they are willing to buy other Apple products as well. If you wanted to invest in Apple in 2016, many people would say that you are quote unquote too late because this product was widely known to consumers now. But had you had invested in 2016, you would have returned 28% by now. Yes, this is a cherry-picked example, but it follows Lynch's framework. Second is to do your own research.
Well, I think people, they're investing in individual stocks. It's sad they're careful when they buy a refrigerator or an airplane flight. They're careful with their money, and they'll hear about a stock on the bus, and they'll put $5,000 or $10,000 on it. They have no idea what they do. So you're really got to be careful. Look at the company, look at the balance sheet. What is the reason the stock should be higher? The sucker's going up is not a good reason.
Lynch was well known to do extensive research on the companies he wanted to buy. His favorite metric was PEG, which is price per earnings divided by growth. Because stocks have different share counts, you directly can't compare their price. That is comparing apples to oranges. The PE ratio, or the price per earnings ratio, allows you to compare apples to oranges by dividing the earnings or profits per share divided by the price per share. You can compare different companies to understand the price you pay per dollar they earn. But what if one company is growing and the other isn't? This is where the PEG ratio comes into the picture. PE, like we talked about earlier, is price per earnings, but the G in this case is growth.
Well, I think looking for something different, looking for something that's a good story. I mean, who would have guessed TJX, a local company, would have gone up 50-fold, or Stop and Shop would go up 10-fold, or Analog Devices, or NVIDIA. I couldn't pronounce NVIDIA. So you have to find a company that's either a turnaround or a company that's going to grow, like Panera or, Family Dollar stores. I'm not saying they're buys now, but that's what's made our, Sears is rolled over. So Kmart's rolled over, IBM slowed down. But we've had new companies come along. I mean, that's the nature. You have to be looking for new companies and look at the balance sheet. If you can add 5 and 5 and get reasonably close to 10, you should be able to look at a balance sheet and say, here's 2 depressed companies. They've gone from 50 to 3. One company's got $3 million in cash and no debt. One's got $3 million in debt, no cash. Which one are you going to buy? I mean, that's not too hard to do.
Again, for example, when we talk about Apple, their PEG ratio is 2.80. But for a growing company like Palantir Technologies, who specializes in big data analytics, their PEG ratio is 0.80. Lynch liked to invest in companies whose PEG ratio was less than 1. This is how he determined a value of a company. Next, you have to take advantage of flexibility. Lynch realized that retail investors have some huge advantages over Wall Street. First is size. When large hedge funds buy or sell positions, this impacts the stock price. Retail investors, however, don't face this issue. Second is flexibility. If you wanted to get out of a position for one trade, you can. But selling and buying all the time will hurt your return. We will talk about this point more in detail later. Next is the Average Joe Advantage. Ultra-rich portfolio managers don't know which services and products the average Joe likes. This is a huge advantage that Lynch saw for retail investors. Next is to take advantage of your time horizon. Portfolio managers are judged based on their quarterly or even annual returns. They need to beat the market, if not they're fired. As a long-term investor, Lynch did not focus on the monthly returns of the company, but more on the returns of a company over various years. This allowed Lynch to make more rational decisions and pick stocks that he knew would outperform the market in the next decade. Despite Peter Lynch's insane returns of 28%, retail investors only got a subpar return of 8% from his funds. This is because investors have a tendency to buy high and sell low. When, if you ask anybody, they always say they do the opposite when this is far off from reality. Even for SPY, which tracks the S&P 500 index, which consists of the top 500 publicly enlisted American companies, the return was 4% for retail investors, when the index returned almost 11%. This is why dollar cost averaging is one of the best and the easiest way to invest your money. Every month, invest a certain amount regardless of what the stock price is and hold for the longer term. This is Peter Lynch's framework. I hope you enjoyed this video and got something out of it. For me personally, this was extremely insightful and just more reasons for me to look into companies whose products and services I really enjoy. I hope you enjoyed this video, and I shall see you in the next one. Bye!
Well, we've had 13 recessions since World War II, and we've had 13 recoveries. Maybe we're going to have one. If this is a recession, it's probably the most predicted one ever.